April 6, 2026 is a date that every pensioner in the United Kingdom needs to have circled on their calendar right now, because on that date, the most significant set of changes to the state pension in recent years takes effect simultaneously, and the impact on your monthly income, your tax position, and your entitlement to means-tested benefits is real, immediate, and in some cases larger than anything you have experienced since you first began receiving your pension. These are not rumors. These are not leaked documents. These are confirmed, officially announced changes from the Department for Work and Pensions that are already in the public domain and that every senior in Britain deserves to understand clearly before they take effect. Welcome to DWP Truth. This channel exists to cut through the complexity of the UK benefits and pension system and give you the honest, accurate, and actionable information you need to protect and maximize your retirement income. No sensationalism, no exaggeration, just the real facts about what is changing in April 2026 and what it means for your financial situation. Stay with me until the end because the final section covers a benefit that hundreds of thousands of pensioners are entitled to but are not claiming, and that the April changes make more important to understand than ever before. Let us start with the biggest change of all, the triple lock increase to the state pension. The triple lock is the government's commitment to increase the state pension every year by whichever is the highest of three measures: earnings growth, price inflation as measured by the Consumer Price Index, or 2.5%. For the 2026 to 2027 financial year, which begins on April 6, 2026, the triple lock measure that has determined the increase is earnings growth. The average earnings growth figure used for this calculation was 4.1% based on the growth in average weekly earnings for the period used by the DWP formula. What does 4.1% mean in concrete pounds and pence? For those receiving the full new state pension, the weekly amount increases from 221.20 to 230.25 per week. That is an increase of 9.05 per week. Over the course of a full year, that represents an additional $470.60 in state pension income compared to what you received in the 2025 to 2026 financial year. For those receiving the full basic state pension under the old system, which applies to people who reach state pension age before April 6, 2016, the weekly amount increases from $169.50 to $176.45 per week. That is an increase of $695 per week, or an additional $361.40 over a full year. These increases are applied automatically. You do not need to do anything to receive the higher amount. From the first payment you receive after April 6, 2026, your state pension will reflect the new increased rate. However, there is one important verification step that I will return to shortly because automatic does not always mean correct. The second major change in April 2026 concerns the interaction between the increased state pension and the income tax personal allowance. This is the change that is catching many pensioners completely off guard, and that has the most complex implications for your financial planning. The personal allowance, which is the amount of income you can receive each year before paying income tax, has been frozen at $12,570 since 2021 and will remain frozen until at least 2028 under current government policy. The full new state pension for 2026 to 2027 will be $11,973 per year based on the new weekly rate. This is now very close to the personal allowance threshold. For pensioners who receive only the state pension and have no other income, there remains a small gap between their state pension income and the personal allowance. They will continue to pay no income tax on their state pension alone. But here is where it becomes critically important. If you receive any additional income on top of your state pension, a workplace pension, an occupational pension, rental income, part-time earnings, or savings interest, the combination of that additional income and your state pension may now push your total income above the personal allowance threshold in a way that it did not in previous years. The increased state pension closes the gap between the pension and the tax threshold, and any additional income that previously kept you just below the taxable threshold may now tip you above it. If you are in this situation, you may receive a new tax code from HMRC or you may be required to complete a self-assessment tax return for the first time. Do not ignore any correspondence from HMRC that arrives in the coming weeks. Read it carefully, and if you do not understand it, contact HMRC directly or seek advice from a Citizens Advice Bureau or a qualified tax advisor before the deadline passes. The third change in April 2026 concerns pension credit and the changes to the thresholds that determine eligibility. Pension credit is a means-tested benefit administered by the DWP that tops up the income of pensioners whose weekly income falls below a guaranteed minimum. It is one of the most valuable benefits available to lower-income pensioners in the United Kingdom, and it is consistently one of the most underclaimed benefits in the entire welfare system. Approximately 850,000 pensioners who are entitled to pension credit are not currently receiving it. For 2026 to 2027, the pension credit guarantee credit threshold increases to $227.10 per week for single pensioners and $346.60 per week for couples. These thresholds have been uprated in line with the triple lock earnings measure. What this means practically is that if your weekly income from all sources, including your state pension, any workplace pension, savings income, and other benefits is below $227.10 as a single person or $346.60 as a couple, you may be entitled to pension credit that tops your income up to these levels. But pension credit is more than just the income top up. Receiving pension credit is what is called a passport benefit. It automatically entitles you to a range of additional support that has significant financial value. Free NHS dental treatment, help with NHS sight tests and glasses, the warm home discount of $150 off your energy bill, full housing benefit if you are a renter, support for mortgage interest if you are a homeowner, and critically, from this year onwards, eligibility for pension credit is required to receive the winter fuel payment following the government's decision to restrict the winter fuel payment to pension credit recipients only. That last point deserves to be stated with complete clarity because it has the most significant implications for lower income pensioners. The winter fuel payment of between $200 and $300 per eligible household is no longer paid universally to all pensioners over a certain age. It is now paid only to pensioners who receive pension credit or certain other means-tested benefits. If you are not receiving pension credit and your income is below the guarantee credit threshold, you are potentially missing both the pension credit top-up and the winter fuel payment simultaneously. That is a substantial amount of money that you are entitled to and not receiving. How do you claim pension credit? You can claim by calling the Pension Credit Claim Line on 0800-99-1234, which is free to call from landlines and most mobile phones. You can also claim online through the government's website at gov.uk pension credit, or you can ask someone to claim on your behalf. The claim can be backdated by up to 3 months, so do not delay because you are worried about having missed out. A claim made today can still recover up to 3 months of payments you should have been receiving. The fourth area of change in April 2026 concerns the state pension payment dates and the schedule for the new financial year. The DWP pays state pension on a specific day of the week that is assigned to each pensioner based on the last 2 digits of their national insurance number. This payment day does not change. What changes in April is the specific calendar dates on which payments fall and the interaction of those dates with bank holidays. April 2026 includes the Easter bank holiday period with Good Friday on April 3rd and Easter Monday on April 6th. April 6th is also the first day of the new financial year and the date on which the new higher state pension rate takes effect. However, because April 6th is a bank holiday in 2026, the DWP has adjusted the payment schedule to ensure that pensioners receive their payments before the bank holiday period rather than experiencing a delay. If your normal state pension payment day falls on or around the Easter bank holiday period, check your bank account carefully in the days before Good Friday. The DWP will have brought your payment forward to the last working day before the bank holiday. Do not be alarmed if the payment arrives earlier than your normal payment day, and do not assume that because the payment has already arrived, you have been paid twice if a regular payment then follows at the normal interval. The fifth and final area I want to address before we close is what you should do to verify that the changes are correctly applied to your specific situation from April 6th onwards. The first verification step is to check your state pension forecast if you have not already claimed. You can do this through your personal tax account at gov.uk, check your state pension. This forecast shows you your current entitlement and any gaps in your national insurance record that could be filled to increase your entitlement before it is too late to do so. The second verification step is to check your first payment after April 6th against the new rates published by the DWP. The DWP's own records show that a small percentage of pensioners receive incorrect payment amounts in the first cycle after a rate change. Errors are rare, but they happen, and they are corrected much more quickly when the pensioner identifies them proactively rather than waiting for the DWP to discover them independently. The third verification step is to assess your total annual income from all sources in the context of the new state pension rate and the frozen personal allowance. If your total income is close to $12,570 per year, seek advice from HMRC or a tax advisor about whether you are likely to become liable for income tax for the first time or liable for a higher amount than previously. And the fourth step is to check right now whether you or anyone you know may be entitled to pension credit. Use the pension credit calculator at gov.uk pension credit eligibility or call 0800 99 1234. 5 minutes on the phone could unlock hundreds, or in some cases thousands of pounds per year that you are legally entitled to and not receiving. Here at DWP Truth, we believe that every pensioner in the United Kingdom deserves to receive every pound they are entitled to, not because the system generously volunteers it, but because you earned it, you paid into it, you built it, and understanding what it owes you is not a luxury, it is your right. If this video helped you, hit the like button right now and share it with every senior you know who needs to understand these April changes before they take effect. Leave a comment and tell me whether the triple lock increase brings you closer to the income tax threshold and whether you have ever looked into whether you might be entitled to pension credit. I read every comment and respond regularly, and if you are not yet subscribed to DWP Truth, subscribe now and turn on the notification bell, because in the coming days we are covering the full step-by-step guide to claiming pension credit and every other benefit change that takes effect in April 2026. See you in the next video.